In this episode of On the Tape, I welcome in Adam Parker, founder, CEO, and chief strategist at Trivariate. Adam has built both an institutional retail investor following over the years, and through his research and contacts has become an important voice in the investor community. We discuss US dollar weakness and why it's good for now, but could cause some issues if it goes too far. Adam focuses on margin expansion among the large tech companies and why that should provide comfort even at these valuations. Adam digs into the healthcare sector and why he thinks that margin expansion is headed their way as well. Adam also favors the financial services stocks and gives us his thesis. A lot to unpack in this episode, so please enjoy. And welcome to the On the Tape podcast. I'm your host, Danny Moses, and I am thrilled to have my friend Adam Parker, founder, CEO, and chief strategist at Trivariate, join me today. Adam, welcome to the pod.
Thanks for having me. Great to see you, Danny.
So you were a guest on our original On the Tape pod, but for the listeners and viewers who don't know you, although I'm sure they see you with Scott Wapner on Halftime Report, Closing Bell. You were on Squawk on the Street this week. Why don't we start with your background a little bit, and then we'll talk about everything that's going on here.
Thanks. Well, we have a business, Trivariate, that we sell, content on U.S. equities to institutions. And then we also have a business, Trivector, that any individual or financial advisor can buy. It's a $100 a month service where we provide a lot of insights about U.S. equities. We have webcasts, people can ask questions. We have videos. We have ETF analysis. We offer tech ideas, the sort of things that individuals want. So that's what we do now. I'm from Boston, so I root for the Boston sports teams, which isn't always wildly popular when living in New York the last 30 years. But I have a PhD in statistics, and I was really focused my whole career on equities. So sell side and buy side, analyzing equities for my whole career.
I think we met when you were at Morgan Stanley the first time when you used to come in the office. You were always very helpful. So I know you like to basically host in person, and you do some of these webinars with your clients on the institutional side. I know you have one coming up. We're going to get to that. You just recently had one on June 24th with kind of 25 buy-siders, as we like to call them. And it was really interesting because I saw your report on it and kind of the surveys that came back. And if you want to be bearish, you should read it because it'll make you want to be bullish since everyone in there. I don't want to give it away here, but talk about that because I thought that was really interesting.
Look, the dream scenario, if you're a prognosticator of equities, is to be contrarian and bullish, and then ultimately be right. That's the quadrant you want to be in. The worst is you're bearish and you're wrong. Right?
Well, you want to be right. By the way, you'd rather be right for the wrong reasons. Anytime you're right, that's a good thing.
Yeah, so I think the market, going up is what you want. And when we surveyed the crowd asking for different bands, the market going to be down 5 by year end from here, plus or minus 5, up 5 to 10, et cetera. Nobody in the room picked up, market will be up 10% or more. And so it's sort of interesting because I think you're in this weird kind of saddle here where we expect some tariff-related problems on margins for some companies in the August or October timeframe, some kind of growth scare. But we know what's coming is the initial sort of phases of the benefits from the AI investment. We know NVIDIA had the big upward sales revision May of 2023. And at that time, we were told it's kind of a 3-year deployment cycle. So it sort of feels like, you don't want to get too negative when you've got this like beginning of a once in a decade kind of margin enhancement thing on the horizon.
Yeah, it's really interesting. One of the things that came out of that meeting also, I believe, was the US dollar. And I want to talk about that for a minute because, and maybe you and I differ a little bit on this. I totally understand the fact that a weak US dollar is good for US companies that export. I totally get it. But at some point it becomes a problem. And if it goes down for the wrong reasons, that's also a problem. If it's going down because people think now the Fed's going to be cutting because they're going to replace Powell eventually, a shadow Fed comes in, all this, that, and the other, I totally get it. But if it's down because, let's back up a little bit to April here, Adam, when the tariff stuff was going on, and it's still going on, by the way, and are we a trusted trading partner, et cetera, the dollar kind of lost its place here. When I say lost its place, maybe from a reserve currency perspective, dropped 5 to 7 points, which, by the way, is huge. I don't know if that's the exact number. So where do you draw the line on a weak dollar is good for earnings? And then at some point, whatever's causing weak dollar or what a weak dollar might mean for the overall markets?
Yeah, no, it's a great question. I mean, it's definitely the consensus view of the dollar will keep weakening for sure. And sometimes when it's that much of a consensus, it doesn't happen, right? I think people are just playing that game of like where we are in our fiscal austerity cycle versus, say, Europe, where we are in our monetary cycle, policy-wise, and so they're just trying to play that trend. And so I could see it continuing to weaken, to be clear. And that like everything is a 19 variable problem that like my mind always tries to isolate to one so I can understand it. But like the tenor of your question, Danny, is like, look, at some point, if stuff gets more expensive for non-US people, it's hard for them to buy it. There's commensurate loss in unit demand. It hurts the companies because the tailwind they get from the currency, on a translational basis is not enough to offset the lack of demand on a transactional basis. And like, I don't know the answer to that question. My sense is it's not there yet. We are at a 3-year low against the DXY, but these cycles can last 5 years, 7 years, right? And so if we're really at the beginning of that kind of cycle, I think it will hurt demand. And I read every day now stories about people being super bullish and what could break things. And I guess the two things that everyone comes back with are your point that ultimately you get like a consumer slowdown, that people just can't consume at the rate, and the other is that the bond yields back up, and there's that relationship in sort of foreign entities buying U.S. Treasuries. So those are probably the two things that I'm eyeing that are correlated to the dollar downstream.
I was shocked when we bombed Iran and the dollar was actually weaker that day. And so that was the one time I would have thought everything else was kind of lined up. We knew oil would, potentially come down if the Iranian threat was kind of gone. I get it. The market tends to project out, but that was one thing that kind of did make sense. But I want to hone in on rates, because you just mentioned, we're trying to figure out where rates are going to be. What is the rate? Where are rates restrictive for the economy? Forget about the short end. I'm really talking about the long end here. And maybe this is too pessimistic, but it's a possibility. And I want to get your thoughts on this. Why can't the U.S., which we had glimpses of it, a couple of months ago, have that Liz Truss moment, that went on in England, in terms of obviously losing control, so to speak. And so here we have this tax bill, right, which we know is going to cost us a lot of money in terms of debt that we're going to build from that and so forth. And again, I feel like we take it for granted that I'm going back to the dollar now and how it relates to that we have our standing in the world. What happens in that moment, Adam? Because if rates start to move higher because our inability to get our house in order, what does that look like? I mean, is that just...
that would be bearish. I think there's no question that would be really bearish for multiples. I guess I'm like the dumb equity guy who resists that happening. But I admit to you that there's 20% of the buy side and a lot of fixed income people who think it will. So it's not a crazy thesis. It's in the distribution of outcomes. Here's why equity focused guys like me are jaded to that view. Okay. When I worked at Morgan Stanley and you were there for part of that time, the interest rate strategists would always call for a backup in yields based on supply versus demand. They'd say, there's a bunch of, auctions coming and there's all the supply coming and it won't be mad. And so they're going to back up. And they call for interest rates to back up. I think all 7 years I worked there, and all 7 years they went lower. Okay. And even during QE1, QE2, QE3, twist, torque, whatever the hell they were all called, every single time the 10-year yield went lower, because when people were afraid of a recession, they buy the 10-year yield. So like, I think that the challenge is like, I can't wrap my arms around why exactly the yields would back up if I'm really afraid of growth. So I kind of feel like if there's a growth scare, we're still going to have lower 10-year yields, even if the growth scare is, hey, we're going to get more austerity, or we're going to doge the fiscal spending or whatever. So like, I don't think that that's a likely scenario, the whole bond vigilante thing. I don't think that's like a high probability outcome I should position for. But if it does happen, it's wildly bearish for multiples.
Let me give you a scenario where it could partially happen, right? So jawbone the Fed. The market's already doing it, by the way. Fed fund futures are now 3 cuts for 25. We were 2.5 as of a couple of days ago. And so at some point during that period of time, if you still have inflation, yet Trump and the White House demands whoever's going to come in, or if Powell ends up leaving, we know short-term rates are going to come in. If the interest rates start to tell you, because the market's going to do what the market's going to do, and it's setting rates higher, then we're completely boxed in. Because at that point, then if you're still intent on cutting short-term rates and Fed funds, that's going to come at a huge cost. That's what I'm talking about.
Yeah, I think it's bullish if they do nothing, to be honest with you.
I agree.
And I know there's like increasing sentiment. We get the weird jobs report on because it's July 4th, the day early on third. Like, we have some data points coming, but if you're sitting here now, right, like it's pretty hard to create a scenario why we won't have more productivity. I mean, there's a story out today that Amazon's got more than half the people, half the productivity in their factories are robots, right? Like that the people they're hiring are managing the robots. Like it's not hard to create a scenario where we could have a rise in unemployment, or we could have a lot of growth from the biggest 500 to 1,000 companies on the top line without any net hiring. And so I think they've got to monitor this unemployment thing pretty carefully. And that's obviously one half of what the Fed's trying to do. The stable pricing, like, look, I mean, I'm not convinced we're going to have as much inflation as people think. And the reason is because when we had inflation during the post-COVID era, which is really fresh in everyone's mind, you forget, but we had the highest nominal GDP in my lifetime. So the demand was strong, and we closed factories because of the virus. So you had the double whammy of less supply with high demand. Remember, we printed, a payment protection program, all that stuff where we gave people money. So I don't think we're going to have that much inflationary pressure. The biggest 50 names have kind of proven they're a little bit immune to rising inflation. The banks, the financials generally are in pretty good shape. So like, I think we're talking about 200 of the 500 companies having some margin impact, not like the whole system being screwed.
So you just brought up the literally $1 trillion question, which is companies gain productivity, margins move higher, which is, I know, what you focus on. In a margins moving higher scenario, you can have multiple expansion, and all the other historic numbers don't mean anything. I totally get that and appreciate that. Here's my issue with this efficiency. Amazon, to your point, is laying off tens of thousands of people. A lot of those big tech names that we're talking about, expanding margins, are laying people off. At some point, again, the layoffs into the U.S. employment system, the ability to buy goods and buy things, somewhere in there's a trade-off. And maybe it's not now, Adam, but it's coming. And I also want you to answer
right.
that.
That's bearish.
I want to go into healthcare on that. Answer the first question first, because you can't ignore how efficient, how amazing technology is for these companies and what's happening.
So what I've concluded, like everyone else, I guess, is that the big companies keep winning, right? Like 40% of the entire S&P 500, 40% of the dollars, gross profit dollars are above 60%. Like so much of the market has high margin now. So the S&P 500 or the top 100 or whatever are just a superior asset class. And that's why I've seen small caps lag. And you get all these guys marketing their small cap products on TV. And I'm like, I don't know what to say, but like, they're like structurally inferior, right? So the question is, can they catch up with AI? Like, I sort of feel like we have a small firm and I can compete now because I have an NVIDIA chip on EQIX. I can read every earnings call transcript. We do a ton of natural language processing. Like, we're able to compete because of technology. So the question is like, is there like a bimodal distribution where people embrace AI and can benefit from the productivity win, people who are impregnable win, and then those that are potentially disrupted just keep getting lower and lower multiples. And so from the stock market perspective, like cheap stocks are bad because if they're cheap, the market on average is telling you that the probability of being disrupted is growing, not that they're an underappreciated value. So like a lot of things change and like valuation gets bastardized and all that kind of stuff. So I think it should be like an amazing 2 years for stock picking, where if you can like locate who you think is going to have higher margins, they probably get multiple expansion. Your question is more of an existential one, which is like, look, man, if you go watch Ready Player One, and you'll say, what you're saying to me is, Adam, 10% of Americans are going to be getting the government to pay for DoorDash delivered to the door while they're watching something like Meta, virtual reality, and they're on drugs. And like, that is possible, but I don't think we're there yet. I think the jobs that Amazon's talking about hiring are like AI jobs, fixing robots, like training the robots, managing the robots, looking for errors, legal. So like, this is in every profession. Like, I've argued most of what investment bankers do is useless. A lot of what first-year lawyers is useless. A lot of sell-side research. We're doing some work here, Danny. Can we launch coverage as fundamental sell-side shop with no analyst? Like, could I launch coverage on NVIDIA with no analyst? I could show you, I could publish a report saying, hey, buy-side analyst who wants to know what I think of NVIDIA, here's what I typed into Grok, or here's what I typed in ChatGPT 03 deep research. I said, I think it will grow 50 this year, 25 next year, 5% above GDP into perpetuity, margins oscillate between here and here, taxes this, what are they earning in 2030? Here's all my data on EV to growth, GP and EV to forecasted sales for every tech company. What do you think this thing should trade at fair value in 2030? It gives you an answer. And you know what? I then asked it, what introduces volatility into NVIDIA's P&L? And what came out was pretty damn impressive. I used to be, as you know, a fundamental semiconductor analyst for a long time. I was like, pretty good. It had like a whole list of things. And we published this actually. And it was kind of like, they all made sense. Like it could be China tail risk, both from demand and supply. It could be, Taiwan semi. There was a whole list of things that all made logical sense. And I thought, maybe I can do what 900 analysts at Morgan Stanley do with I can maybe do what 400 of them do for free.
Yeah, but you also won't be jaded, not just Morgan Stanley, but the rest of the street in chasing investment banking So you're completely independent. As far as I know, your firm is not doing investment banking. Right. So you can absolutely be objective. So you're right. There is a place for that. And well, I've told people, and so have you, that, you always got to look at the sell side research and really understand what it's all about. And the amount of buys versus sells, obviously.
We studied this. It actually has changed, Danny. And I posted a note on this a few months ago. The title I wrote was a little click inducing, which isn't my strength, but we did it a few years ago. What we wrote is it actually made some sense to do the opposite of the analyst. So the best thing you can do is buy a stock where the stock's up, but the sell side doesn't like it. Like, that's a great combo, right? And it turned out that there was information in it that you just did the opposite of their ratings and the upside to their price targets. It now changed where there was no information. So what I wrote is the sell side analysts are useless. That's what I meant by no information, because in aggregate, their buys don't beat their sells. The stocks they upgrade don't beat the stocks they downgrade. And every day you and I walk in, we get the whole like ratings change thing, and it's in Barron's and it's like everywhere. And the idea would be, oh, there must be some smart analyst who's upgrading it. There must be information there. But if you long the ones they upgrade and short the ones they downgrade, you make zero excess return. That's what I mean by useless.
I want to go into healthcare, because that's an area you've been talking about, and you just identified if you can find a sector where margins are going to start to increase. It's not being appreciated yet from technology and efficiency. So talk about that and kind of where you're focused there.
Like all these sectors, they're really diverse. I think it's the biggest AI beneficiary sector. And I think that there's a chance it's the best performing sector from here for the next 10 years. And if you look at like an Oracle being a good stock in Q2, which they bought Cerner a few years back, like I think this tech healthcare combo is going to be massive. So the bull case for healthcare would be, look, there are a lot of businesses in healthcare that have tons of employees, low margins, and high revenue. And so if you or I were CEO, we would say, well, how do we get more efficient at predicting our customer behavior and our employee behavior so that we can kind of raise margins? The stocks that have worked, McKesson, Cardinal, Cencora, they're drug distributors. For people listening, if you've even heard of McKesson, I'd be impressed. And then if I asked you what the revenue was and you got close to being right, I'd be doubly impressed. McKesson does about $350 billion in annual revenue. Okay, that's got to be the highest number for a company that most people have never heard of. Okay, why have you never heard of it? Because they do 1% margin. They're a pass-through. But if they get their margins to 1.5, because they know, hey, this many people in this county, they need statins. This many people need, whatever, pulmonary medication. Like they should know. And remember, these companies all paid big fines on the opioid stuff because they shipped a gazillion opioids into West Virginia towns with no people in it. So as they get better at their analytics, if the margins go from 1 to 1.5, that's called 50% earnings growth. And so these things can trade at 30, 40 times earnings as people predict margin expansion. We've seen it with Synthos, with Costco, with Walmart, with all these low margin businesses where people dream the margins are going higher. So I think healthcare's got a ton of that. And then, secondly, I just think there's just so much offense. Like, I'll just give one quick anecdote. I took an AI for healthcare course at MIT last summer, 6 to 8 hours a week, 6 weeks. And I was like mesmerized by the inefficiencies and potential. I'll give you two quick things. One, I think in a few years, every house that's built will have a box on the wall that's like a wearable multiplied by 1,000. So people are wearing Whoop rings and Oura rings and Apple watches, and they're tracking. This thing is going to be awesome. It's going to look at the electromagnetic waves. It's going to check your breathing, and it's going to be like, hey, Danny, you have a gallstone issue. Go get that checked out. Or it's going to know everything about you because it's going to be so efficient. It's going to be designed toward increasing your human productivity. So I'm wildly bullish on like that technology part. And then to be more specific on AI and healthcare, and then I'll shut up. Breast cancer, all right? Radiologists, even the best of them, are not very good at what they do. It's not their fault. It's hard. There's a thing called dense tissue, and dense tissue is associated with a higher probability of breast cancer. If you gave 100 expert radiologists the same images, one might think 6% of the images have dense tissue. One might think 36% do, and they're looking at the same damn images. They're spending all day looking at images, not talking to patients. Well, guess what? Women go for years proactively to get imaging done, and there's a gazillion images. So guess what's already better than humans by a mile at predicting whether women have breast cancer? These AI models. And if you think about the way that system works, type 1, type 2 error, we want to have zero chance that you have cancer, and I don't tell you have cancer, right? But I'm willing to put up with pretty high type 2, meaning I tell you have cancer when you don't. Well, think about that population. I tell you have cancer, you don't, but like your mind is FUBAR from this, right? Prophylactic double mastectomy, you have to have cosmetic surgery, you do maybe even do chemo. Like there's all this cost and penalty associated with that type 2 error. Now, like that goes to asymptotically to zero. So like, I just think there's incredible upside efficiency and productivity in that one example. And that's going to be headed everywhere over the next several years. And then later on, there'll be stuff like Google computational chemistry and all that, years from now. So I'm like, I think it's the dreamiest of dreams in terms of like efficiency, productivity, margin expansion. When you go to a doctor, did they hand you a clipboard and tell you to circle stuff with a pencil?
Yeah, it's still going on. That still goes on.
That's insane. That's insane. Like, why aren't they scanning your retina and being like, yo, you're Danny Moses. You're a physical specimen. You're a good swimmer. You hit the golf ball pretty far. Like, it should know everything about you.
Well, my doctor is Dr. Parker, obviously, so this will go well. So within all that, Adam, one area that is going to be in high demand is energy. And, to me, that's an area similar to healthcare. Maybe doesn't get the AI direct benefit within their businesses because it's very labor intensive. It's hard to get away from it. But for oil discovery, it is. You can use technology. But within that, the demand on it, if you really believe in this AI trade, why is this sector now? I think it may be up to 4% of the S&P, or almost hit it during the bombing going on. But to me, it's still a sector you can look at with decent capital return. But did anyone mention that on your offsite? Or
yeah, we've had some pitches in that sector recently. I'll answer that question like more like the trader mindset, which I know you're very, good at, better than me. But like, look, we had it as our biggest overweight in 22 and 23, and it worked. And then it started to underperform in 24, and I downgraded it. And the reason I downgraded was I just started realizing there's no way the multiples are ever going to expand ever again. So here's the fundamental case for it. Okay, I think some year, 4 or 5 years from now, maybe even 6, there'll be a day, 2030, 2031, where more oil is demanded and consumed than any day previously in the history of planet Earth. That math is already a fait accompli based on the installed base of vehicles that are out there. People buy cars, they're born, and then they die, and they last between 11 and 14 years, depending on where you live. 14 if you live in Florida, 11 if you live in Massachusetts or whatever, right? Just, weather or whatever. All right, so based on what's already been sold, there was a little bit weaker EV adoption in the last few years. Peak oil demand is going to be in like 2030, 2031. Then after that, every kind of year, there'll be less oil demanded probably for the next 20 or 30 or 40 years after that. So I think what's going on is you and I could say, well, wait a minute, the math seems awesome. In the next 5 years, there'll be a peak, and then it'll slowly erode back to today's level. So 10 years from now, I might have oil demand where I am now. Like, sign me up at these valuation levels and this negative sentiment. But I think the counter argument is just that the multiples, you may end up at 5, 6, 7 times earnings at the end of this rainbow, just because people know what's coming is not 108 million barrels in 2031, but 50 or 60, 30 years from now. So I think it's a valuation issue. What I think you're saying, or what I believe, is that if I were a billionaire, you know what I would do? I'd be like a wildcatter, man. I'd put like 100 million of my PA into like owning some actual rock and Permian, generate 15, 16, 17% cash and cash return, get my money back in 6, 7 years. Then everything after that would be through the roof, and I'd own the asset. So like, I think there's a difference between what you're saying, like the private equity LBO valuation, and that public equity sort of problem that you and I can't totally deny, which is that the multiples might just grind lower forever.
I mean, I think there has been a lot of M&A. I think there'll continue to be M&A, so that's bullish. I think that
you see Hess and Dime, but Hess was at no premium, and Hess sold knowing his acreage.
So the ExxonMobil deal. I'm just saying, but you've also seen a lot of smaller ones which have occurred. And listen, the balance sheets have never been better. The ability to adjust to what you're talking about, the rig counts are low. They're the lowest they've been in 5 years. And these aren't just oil. A lot of these companies, have natural gas as well. And that's one of the
I'm fundamentally like directionally positive, but I'm like stock wise directionally negative because I'm worried about the multiple. But look, I think it's if the S&P you're long only, you're trying to beat it at 4% weight. If you said you want to own 6 or 7, I'd say cool. What people want to own is the toll collectors, Williams and
yeah, fair enough.
And kind of just play the pipe game or there's some really weird laws. I don't want to get political, but like Massachusetts, which is a historically very blue state, still imports European natural gas. Like, there's some weird stuff just because of the way. So you may get this regulation thing could actually be bullish for demand a little bit if we do get regulatory release. But if you're saying, Adam, your job is to beat the long only with your suggestion, I don't know, man. Keep it like 4 to 6%. Move on. Like, I just don't know if I get multiple expansion.
All right, let's talk about Bitcoin. And it's not just Bitcoin, crypto in general. We have reached the .com point now when you have companies that are raising equity, buying crypto, and trading it 3 to 4x times the underlying value. Obviously makes no sense. We know that's not a sustainable thing. So you had mentioned that Bitcoin, part of the surveys were trading as junky tech, right? Which it was, but love to get your thoughts on it here.
I think it's changed a lot. I think it used to trade very highly correlated to ARC or what we call hypergrowth junk equities. And it's now starting to trade a little bit more like high quality, right? It's definitely branched out. If you survey a room every 6 months and ask how many people in the room own Bitcoin, it was less than the majority, but maybe half the room, a little less than half the room, 30, 40%. So more people are saying they're owning it. Obviously, there's ETFs now. People can take custody of it, or big firms. So, I've heard of a lot of more compelling arguments. I think there's something like 57 million millionaires in the world. There's 19 million Bitcoins. Bitcoins will grow between 1% and 2%. The millionaires will grow faster. You may get just more and more demand. And I think the thing's fairly legitimate in terms of its asset size and all that. So I think you're seeing like advisors now say, okay, Danny, you got 30 million bucks. You're, 7 years old. Like you want to allocate 5% to some combo of, fiat currency, doo-doo. One of the guys who pitched Bitcoin at my conference last week referred to the US dollar as shitcoin during his speech. That's not a phrase I had heard for the US dollar, right? So he's like, well, there's that shitcoin thing. I'm like, I'm sorry, excuse me. Did you just call the US dollar? So everyone in the room was chuckling, but I think it's more legitimate. Like I'm not a raging bull on it, but if you said, do you want to have 3-5% of your asset allocation there up from zero? I think there's a lot of old school advisors. It's not just the 30-year-old bros now, crypto bros. Like I think it's become much more legitimate.
Have you I know you use the NLP for 2,500 earnings calls that go on at a time. Are you using AI for this tax bill to generate what sectors should be looked at and have changed that maybe people are missing? And what are your thoughts on this thing?
Yeah, we didn't really use AI. What we did is we looked at the companies that benefited the most from the lower of the tax rate eight years ago. So who was like the difference between the reported tax rate and the statutory rate, right? So companies were supposed to pay 35%, but a lot of them were paying 19 or 10 because they had Israel or Ireland or Singapore or some offset, right? And so when they lowered the rate, a lot of companies that had low rates already, there wasn't that big of a difference, but those that had high rates, there was a big difference. So if you're worried about it not being extended, a lot of them are U.S. consumer companies or they have no non-U.S. revenue. They really benefited. So if you worry this thing doesn't get extended, you can identify the companies that would most likely be hurt by a new rate.
Yeah, for sure. So that's going to be interesting how this plays out. And again, people are going to hear. So we've had a crazy first half of 2025. I mean, everyone's exhausted. It feels like it's been 3-4 years, right? In the 6 months, we've experienced 3 or 4 cycles already in it, between the rate moves, the equity moves, everything's going on, commodity moves. It's really been wild. And so let's look forward to the second half of 2025 and, you've kind of given clues here where you would be positioned in the higher margin companies with growth experience. So give us your model portfolio right now in the US. And then I'd love to hear your thoughts internationally.
I mean, within the US, I really like financials. And it's the first time really in my career that I can sort of say, I think I could beat the S&P only with financials, meaning like I think there's some offense in financials, I think there's some defense, I think there's like some high quality. I see like a portfolio of ideas. I can be long Progressive and short Allstate. I can be long Capital One on the Discovery stuff. I can be long JP Morgan, Goldman, and Morgan Stanley. I can long alts. I can find some juice with Jeffrey, or I could just find offense, defense, beta in a sector where, before I was like, I don't know what even rate environment I'm rooting for. And like, who the hell knows about, there's just a lot to like in this sector for the first time, and at least since before the financial crisis. So, which is obviously an era, well. So I just feel good about financials in the second half and the risk reward of owning them. I like healthcare. I think it's going to be a while before this pans out, but if we get any kind of evidence that there's, margin expansion potential from AI productivity at a Cencora or a Quest or whatever, I think there could be a bit of a re-rating on the multiples for a sector that's really underperformed. I know when I recommend healthcare, everyone always says, what about United or something like that? And obviously, I just think that's very idiosyncratic, and they're just shining a light on that for the first time. But I think there's so many other pockets, from tools to diagnostics to distribution, et cetera, that I don't think you'll have any trouble finding margin expansion ideas in healthcare. So I like those two a lot. we've been really negative on discretionary. It's been our biggest underweight. I do think that if the Fed cuts, we didn't quite talk about this earlier. I'm not sure it'll be good for equities. And I know you and I agreed that if they pause, it could be good. But if they cut, I think it could be a little bit like the opposite. Remember at the end of 2022, the best thing you could do is cover your NVIDIA and Meta shorts and get long January 1st of 23. Your logic was, oh, well, they're closer to the end of the hiking than the beginning. And so I worry a little bit now that's like exactly reverse, where we're kind of closer to the end of the cutting than the beginning. And they might be cutting now because things are actually deteriorating and it might not be rewarded with multiple expansion at the market level. But I do think what it'll do is cause a big rotation underneath. So I worry a little bit about, this big underweight we have in discretionary, because I think if they cut, maybe there is a 1 month bid for, some of the lagging consumer stocks. So
Housing related. Yeah.
Yeah, that's something. Yeah, maybe even housing gets even if the fundamentals are bad, it might just get a big boost because they're so suppressed. So I think that's, something to watch out for, but that's our biggest underweight right now.
I mean, as long as they're cutting for the right reason. So the, economy's okay, but inflation, has come down and tariffs didn't or may not have the impact that they thought, then I think you can potentially get that. But I want to go back to the banks for a second, because there's something really interesting. So we talk about the stock market, how it's led by a few names. So is the economy in terms of, the wealthy that are driving it. And so kind of the lower end consumer and kind of some of the smaller businesses that use these small and regional, size banks, small and mid-cap regional banks, I think there's going to be a massive M&A wave if, ironically, the economy does slow, because the large banks won't be as exposed on a percentage basis. I think the regionals will, and small banks. So I think there's a wave potentially coming. So I know that's a little counterintuitive, but I feel like the big banks are going to step in from a regulatory perspective. They won't have that overhang to be able to do it. What are your thoughts on that?
I did a dinner a few weeks back with the guy's the CEO of a public boutique investment bank, client of Trivariate, and 8 or 9 institutional investors. And I think we wanted to meet with him to kind of get the flavor of what they think of the M&A market. This was right after the Cox cable deal was announced. It was right after Dick's bought Foot Locker, and there was some sort of burgeoning excitement about an M&A cycle, I'd say. And I was a little surprised to see someone who really would benefit from a big M&A cycle say they were a little more sober, that so far they've seen regulatory pressures release only in the consumer, not really in healthcare, not really in tech. And so, hopefully that's in front of us. Look, we had all these things rip after the red sweep, right? Look at the alts. Look what happened to KKR and Blackstone and Apollo and Ares and Jefferies, and these stocks ripped. Then they got really killed into the tariff scare, and they've recovered some, but are not back at highs. So I think what they're telling you is that, I can dream M&A's going to pick up. It's not in the price. What I like about taking a shot at some of these names is, if you're right, we do get more M&A. They'll go back to highs, and there's a lot of upside. Like if you look at Jefferies, it went from like 40 to 80 to 55. So there's still, 40 to 80 to 40 to 55, right? It's still got a lot of upside to get where it was. So if you want to play that game, I think there's ways to do it. I worry it's a little bit more muted than people think, because, we need just less volatility, a little bit of stability on the interest rate environment. But if we do end up getting an M&A cycle that picks up, I think the financials will benefit. I think healthcare will benefit. And I think you'll see some software deals. I know these big private software companies have raised a bunch of new capital. So I think there's a reasonable chance we get several good ones before the end of 26.
Yeah, I don't disagree on that at all. All right, so let's talk about your upcoming event you guys are having. It's on July 8th. This one's a webinar, right? So
it's our second half outlook. Yeah. I try to be different, man. I read what the other people are saying, and then just sort of try to think about where the highest probability outcome is that is different from consensus. And we're still putting that document together. It's July 1st as we're recording this. And, but I sort of sense that you could be contrarian to be bullish and to be a 10% up guy. And I think it's going to be around AI deployment and not reaching your kind of like economic and consumer problem yet. I think if we get a really good AI deployment at 26 and 27, your consumer problem could be like a 28 issue. It could be around a new president, new policies and other stuff. But I don't think that's imminent. I think we're more in the innocent until proven guilty mode on margin expansion.
So how do people find this then? They go to your website. What's the website they can sign up for this webinar?
Yeah, go to Trivector. It's $100 a month. You can charge it on your credit card and join our July 9th is the individual one, Trivector. And, the Trivariate's for institutions. So if you're listening and you work at an institution and you don't pay us, then call us and we'll try to build a relationship. And if you're an individual advisor, just pay the $100 and go to Trivector.
Well, Adam, it's been quite a first half. I hope people are listening to what you're saying. I'd love to have you on in the back half of 2025.
Let's do it live from Florida, man. Let's do
that. And then we got to get a poker game again. For people that don't know, you are quite a poker player. And I realize I'm playing against an MIT educated poker player who for fun goes to take statistics courses as opposed to going on golf trips. So I may get you on the golf course, but you probably got me on the poker. But yes, let's do both down to Florida.
Let's do a golf day poker night. That'll get on the calendar. Great to see you, man. I love seeing you. I really enjoyed this. Anytime.
Thank you, Adam. Thanks for coming on the tape.